All right. Well, welcome to another expert interview. Really excited for today's guest. We've got Don with us. Before we jump in and I have Don introduce himself, as always, remember to like, comment, and subscribe to this video and the channel so that you can get the videos that are coming out. We're putting out at least one a week, and there's some great experts coming up next. So Don, let's jump straight into it. Why don't you let everyone know who you are and what you do?
Hey, Devin, thanks for having me. I appreciate it. So my name is Don Oberle. I'm the chairman and CEO of Credit IQ. And what my firm and what I've done over the last 31 years is help people understand how the credit algorithms work, how to leverage it to build wealth, and especially this segment of entrepreneurs and people who want to open up a business or expand their business, and how to leverage this knowledge so that they can, obtain, keep. It's not how much money you make; it's how much money you keep. So how you keep the money and expand the business, and that's pretty much it. It's a pretty broad spectrum of what we do, but that's in a nutshell.
Love it. Well, thank you for making time. I know you're busy. I know you and your team are always doing amazing things. So I appreciate you giving us a little of your time and knowledge. First question I always like to ask is what's trending in your industry? What are some hot topics in the credit world?
I would say it's funny. The word that I'm going to use is trended credit scores. Ironically, the algorithms have pretty much stayed the same. So Bill Fair and Earl Isaac in 1964 were mathematicians, and they were hired by insurance companies. And so they had them develop the credit score trending algorithms. And so insurance companies have been using scoring models far longer than lenders have been and employers. And it's pretty much stayed relatively the same over the years. But in the last year and a half, 2 years, they've come out with and they really haven't announced it, that, by the way, a system called trended credit scores. And what it is they're now, most people have heard, hey, if I keep my credit card debts low, then my scores will be good. That's true, or to zero balances. But now what they're doing is they're going a step further, FICO, the credit bureaus, where they're looking at trended scores over the last 24 months. So it's a really important topic that you need to understand because it will affect you. In the old days, up until recently, what we used to do is if a client was attempting to do a business line of credit or buy a commercial building or a home loan or what have you, we'd say, go pay all your credit cards to zero 90 days before the event, lock the credit cards away, don't put a penny on them because you get more points with a zero than you do 10, 20, 30, 50% on it. And then don't touch it. And then that'll allow the creditors to upload a zero balance on your credit report. And then it'll maximize that part of the formula, which is a huge part of it. Well, the powers that be have gotten hip to that. The people are becoming aware how to manipulate a score now. Now they're saying, well, let's go ahead and go back 2 years. And if Devin hasn't been paying his cards off to zero every month over the last 24 months, we're going to take points away from you. Okay. That way you can't game the system at the last minute. So if you want to know what the biggest trend, that's a really important topic that nobody's talking about.
I could see that having a huge impact, right? Because you can't wait now. Like there's no, I mean, you shouldn't have waited anyways, but now there's definitely urgency, right? Because if you want to do something or make a move, like now's the time.
Yes, exactly. Find out where your real scores are at. Most people get their scores from their credit card company, from Credit Karma, these free services, and nothing's ever free, right? And so the only way we're ever going to see the real score is if a lender pulls it or a banker pulls it and gives you a report. And they're expensive. They're like, if you're not paying at least 30 to 50 bucks for these lenders reports, the lender scores, then it's not the real score. And generally speaking, people are walking around thinking, I've got a 700 score. Where'd you hear about that? Well, yeah, I get it from my credit card company, or I get it from the credit bureau themselves as a consumer. But what most people don't realize is the devil's in the details. And in fine print, it always says in the disclaimer somewhere, these are simulated scores, how we think they work, right? So FICO, they lease that data to the credit bureaus. They lease the data to the lenders and what have you. And unless it goes through their system and spits out the black box formula, you're not seeing the real score. So that's another big takeaway for your viewers today, is that if you haven't seen a true lender's report, you're not looking at the real score. You're looking at an algorithm, a simulation. Okay.
So with that, where do they go for that? I know I believe that's something your company offers, but like, how do they go get real reports so they can actually see where they truly are instead of these maybe inflated scores?
Yeah. So the only way to get it is if you've got a friend who's in banking and you have them pull it, and you get all three bureaus, by the way, not just one, because they're different. Or you can come to a firm like myself, our firm, Credit IQ, and we can give you a copy as well.
Awesome. So I love that takeaway already. So two really good things. So we've got a 2-year trend. I haven't heard that. So thank you for bringing that up. I'm excited to see how that unpacks. And then, yeah, let's make sure you're looking at the right scores, because if you're planning, you need to know what you're planning with.
That's right. Yeah. Plan ahead.
Perfect. So let's talk about maybe just like credit 101, right? So why does the score matter? And maybe you could just give me the hit list of like, here's the reasons why it's going to impact you as an individual and as a business, and maybe just rattle some off.
Sure. Gosh, I have 31 years of experience doing this, so I have probably hours of content to give you, but let me see if I can condense it. I'll do my best. So what we all have to first understand is what a credit score really is. It's a risk predictor. And that's why insurance companies started using it in the 60s. Okay. And then later, in the last decade, you noticed most of the Fortune 500 companies, they use it as a risk predictor to hire people, right? Most people are aware of that. What most people are not aware of is that now, in the last couple of years, that they're also using it for employment. They're using it for promotions. So what you could reverse engineer what I just said, folks, is if you've got a small business, what you could do, and I started doing this about a decade ago, and I will tell you, it works. For example, let's say we won't hire anybody in, no matter how much we like them, if their scores are below 700, no exceptions. And I understand there's life, right? There's death, divorce, job loss, medical. I get it. I understand that. But it costs, you as the employer a lot of money to train people when they have to leave, or the grass is greener on the other side for retention, or what the plethora of different reasons. So when someone has, let's say, a 700 score, and you're going to hire a candidate or promote them, and then someone has a 620 score, what they're saying is there's, let's say, a 30% chance with a 620 score that they're going to be late for work, call in sick, or have lack of focus on the job because there's a life event going on. Like I said, death, divorce, job loss, medical, the big four. Doesn't mean they're a bad person. It just means, things are happening, which could relate to, depending on what kind of company you have, it could be an accident. It could be a lawsuit, right? Like we've done Caltrans for that very reason. We said, hey, we'd like to do these coaching with your employees to enhance their knowledge base, to leverage their scores higher, and then so they're not distracted, and then a lawsuit, right? That's one type of benefit. And the other one is obviously that, be late for work, call in sick, have lack of focus on the job. So you could use this information where you're hiring somebody, and just don't hire them below 700. It's up to you. But you will also notice that the retention level will go through the roof. Like we had an 80% increase in retention when we started using this. So there's a reason why the insurance company has been using it for so long, right? The banks, right? So I knew that was a long answer, but it's something you guys could use today in your own businesses. Okay.
So what's the legality of pulling those, or how do I as a business owner go get those scores? Can I just go somewhere and pull it? Does the individual have to pull it? How do I do that?
Yeah, good question. So once again, there is the fake simulated scores you get as a consumer, even from the credit bureau themselves, right? They're selling you a simulated score, or the real one. So once again, you either have a friend in banking that pulls it, or you could come to my firm. almost every application now that has been updated when you apply for a job, it says in there, we're allowed to do a background check, which includes pulling a report and et cetera, et cetera. So as long as that's in your verbiage, which I should be surprised if it wasn't, if it isn't, you need to put it in.
Perfect.
That you can do a background check, criminal, driving, credit, those three things,
Awesome.
right? So as long as that's in the verbiage, then you have the right to do that, and they have to sign off on it though. They have to sign it.
I love that. Again, another takeaway. I was hoping you were going to go there because I know the first time we talked, I've heard it, but I hadn't seen a company like make it a standard like your company had. And then hearing that retention increase is critical, especially right now,
Huge.
right? Everybody's
Yes.
struggling to recruit. And so if you're struggling to recruit, you better be retaining. Otherwise, it's going to become a double-edged sword.
That's exactly right. Right. And it shows up. It shows up. The data, it's the 80-20 rule, right? 80% of the time, it's dead accurate.
Love that.
Yeah.
So let's talk about the savings side, right? So there's got to be some savings for having better credit. What's that look like, and where might I see some savings if my credit score did go up?
Great question. So if what we've seen over the last 31 years doing this nationally with business owners and consumers is that if their income of the person that's elevating the score is $100,000 or less a year, then we're typically saving $300 to $600 a month, or you're saving $300 to $600 a month in interest across the board. If it's over $100,000 a year, it's usually 600 to 1,000 plus, depending on the income bracket, right? So let's just take the average person, 100 grand or less a year. So how I came up with $300 to $600 a month, and it's really accurate, is that once you achieve a 740 or higher lender score, not the fake ones, the Credit Karma and stuff like that, the real one, right? Then you can demand a 0% rate on a new vehicle. Demand it, okay? Except for Tesla, they're the only ones that don't play ball. Yeah, and and that alone, let's say you're at a 620 score, lender score, and you jump to 740. Whether it's through our help or just the education we do or knowledge, then let's say you take a $25,000 car at 620 score, jump it to a 740, that would equate to about $175 a month in interest savings, a month. Now, what business owners what could you do with an extra $179 a month? I mean, probably a lot, right? So, and then once you're at 740, you can demand a 9.9 fixed rate on a credit card, not 18 variable or 24% variable, 9.9 fixed rate, right? And so if the average person is carrying, let's say, 5 grand in credit card debt, it's actually more right now, but let's just take 5. That's an easy 80 to 100 bucks a month in interest savings. Easy, right? So you take 175 plus 80. And then once you're at 740, you can demand cheaper car insurance. So for you folks that didn't know that car insurance uses it, like I said, they've been using it the longest. Home insurance uses it, so you can save money there. And then some business owners have what's called a surety bond. Some of you know what that means, right? So I'll give you an example. We had a contractor up in San Francisco Bay Area. He builds real estate on homes, and he was about a 580 score when we started, and then we jumped into 770, and we taught him these techniques I'm teaching you today. And he went back once he broke the 740 and renegotiated his surety bond for his business. He was paying $9,600 a year in a surety bond. It's a lot, right? Because people can get hurt on the job, right? Once he applied it and just made one simple phone call, he emailed me and said, "Look, hey, thank you so much. My new bill, $650 a year. It dropped from $9,600 to $650 a year. That's huge. What could you do with that kind of money?" And then the other piece is real estate, which is really our specialty as a firm, because that's usually the fastest way to create wealth. So for you business owners that still do brick and mortar, wouldn't it be nice to elevate your scores and then go get some commercial property, and then you rent out half the property, and then the other half you're there rent free with your employees, right? And then you're building equity, right? So real estate's one of the biggest. So generally speaking, we're saving about, on a $500,000 property, easy $300 a month, easy, sometimes more. So if you add it all up, that's an easy $600 a month.
So on the,
I know that was a long answer, but I wanted to break it down for you.
no, it's great. It gives everybody the buckets to kind of see where's it fit your case and, where might it apply. On the insurance side or the credit card side, is that just a call to my broker, my insurance agency?
That's
Is
right.
that a call to the credit card company just saying, hey, I think you need to pull my score again and, you need to change this?
Yeah, good question. So there's a caveat with insurance because often when you call them and say, hey, I'm above 740 on my lender scores, and I need you to drop my rate and drop my payment, or I'm going elsewhere. And often they'll say, well, I don't know what you're talking about. And you'll say, well, then call corporate for authorization, or I'm going to fund somebody else today. Right. So you kind of got to play a little bit of hardball with them because they're a little bit more crafty with it. And sometimes the brokers don't know. They just punch in your data, your insurance broker. They're just, little sheeples that the data's coming down to them, and they don't even have a clue of what I just taught you today. Right. Like, I didn't know about that. Right. And then corporate's the one dictating all this in the background.
Got you. And then the credit card company, is that easier then? You just call them and say, hey, I'm at 22. I mean, what's that conversation look like?
Well, this is a little bit more in depth. I'll try to give it to you in a nutshell. So you've heard the old saying, the third time's a charm?
Yep.
Wrong. It's the fourth time.
Okay.
So, because they've been at this game a long time, they're a lot tougher. So you call up your credit card company. Once you know you're at a 740 lender score, don't go off to Credit Karma, and you say, look, I'm above 740 in my scores. I want you to drop my rate to 9.9% fixed. Or I'm going to go with another card company, and they'll say, well, we can't do that, and you'll say, well, I need to talk with your manager, and then you go to the third manager, and then the fourth manager. That's usually when you get your way, right? And then by the third manager, they're usually saying, well, maybe we can. Since you're so persistent, Devin, maybe we can drop you from 18% variable to 16 or 14% variable. Like, no, I want 9.9 fixed. I'm going to get right. So you kind of got to know, we've got a whole script, Devin, that we can give your audience the verbiage and the flow on how to do it and when to do it. But that's it in a nutshell.
Awesome. Perfect.
Yeah.
I just want to make sure we at least gave them a little bit, but I know there's an art there.
There is a bit of an art form. Yeah. It's not just, hey, I deserve it, you're going to give it to me. You got a little bit more tenacity than that,
Perfect. So let's play kind of a fun little game. I'd love to hear your feedback on this. So I just did a Google search, top tips to improve my credit, and I have a feeling you're gonna have some fun with this. So what I want to do is there's two lists here. They both have 8 tips. So my thought is I'll throw out everything that's unique on them, and just real quick, what's your feedback? Yes or no? Is it going to impact the score or not? And let's just see. Okay. Let's see what people are saying, and then someone who has tremendous experience can actually give us some real knowledge.
Absolutely.
So build credit fast. Number 1, pay your bills on time.
That's a good one. That's number 1. Yes, perfect. I agree with that.
Okay. Ask for higher credit limits.
Oh, let me go back. Let me be more specific, Devin.
Yep.
You have 29 days midnight. So let's say the payment's due on the 1st of the month, Devin. You have 29 days midnight from that date to make the payment. If you go past the midnight, the 29th day, it becomes a 30-day late, and that's when they can get you.
Gotcha.
Right.
Okay.
Some people go, no, but I heard as long as I pay it by 30 days, I'm okay. No, it's 29 days, not on the 30th day, because that's when you're late. So go ahead. Sorry.
Love that. Perfect.
Yeah.
Ask for higher credit limits.
That's a double-edged sword. If you know how to manage if you're very disciplined in managing your revolving debt and stuff like that, that's good. You want to do that 1 year prior to when you're a major event. So if you're doing a refinance or a purchase on a home, a big ticket item or a car, don't do that in less than 1 year prior, because when you do it, you'll lose points for a year. They don't tell you that.
So
Okay.
yes.
And then when they do that, they're going to pull within 90 days, you'll lose points for between 5 and 22 points, 90 days from when they ping you, because they're going to pull your report. And then the new inquiry, you lose points for 90 days. You get it back on the 91st day. So at minimum 90 days prior to a big ticket, you don't want to be doing that at all. Bad idea. Very
Perfect.
bad
And the
idea.
idea, if I'm guessing at why they're recommending that, right, is they're talking about credit utilization, right? They're trying to get you below the cutoff. So that is one of them, right? So decrease your credit utilization. So there's a lot of myths and stuff out there on that. So where is the magic bullet? I mean, obviously 0 is the goal, but are there
Yes.
trigger points that help?
Absolutely. So with revolving debt, store credit cards, lines of credit, things of that nature, if it says revolving on the lender's report, those are the ones you want to pay attention to the most. So for example, if I pay off a revolving account compared to paying off an installment account, I'll get many more points with revolving. Installment carries very little, like paying off a car you would think would be helpful. It's not going to help you that much. Okay. Revolving, you get the most bang for your buck. When it comes to revolving debt, is that if you have to use the card, then just don't ever exceed the 30% mark. So let's say it's $1,000 limit, don't charge over $300. Okay. And when you get the statement in the mail, or when you get the statement, pay it immediately to 0. That's the perfect world scenario. If you're struggling financially where you can't afford to pay that credit card to 0 right away, then what you want to do is look at all your revolving debt and say, I'm going to start with my higher balances that are over 30%. With the higher interest rates, pay those down below 30%. So if it's 1,000, paying below 300. And then the better interest rate cards, then you pay those down below 30. And then once they're all below 30, then go back to the higher interest rates, pay those to 0, from 30 to 0, and then the same thing with the lower interest rates. That's the optimum way to do it if your cash flow is a little tight.
Perfect. I loved your answer on this. I'll ask it here so they can hear it on this interview. Become an authorized user.
In the old days, that used to work great. But when the 2008 collapse happened, the bank, everybody was pointing their finger. Oh, it was Wall Street. It was the banks. It was right. Everybody's pointing fingers, everybody. And then eventually they're pointing at mortgage bankers. And so FICO, what we used to do in the old days is when we'd have somebody that had what's called a thin file or didn't have a lot of credit, we would have them go put themselves on Aunt Susie's old J.C. Penney's card or old Sears card they've had for 20, 30 years, right? The older the cards are, the more points you get. And then we would build their file up that way. We get a home loan for them, right? Well, in 2008, FICO got hip to that, what people were doing, they're gaming the system. And they said, no, we're going to change the algorithm. Now what we're going to do is if you have any blemishes at all on your credit report, like one little 30-day late payment from 6-7 years ago, if you have one little blemish, we're going to show the trade line, Aunt Susie's card on your file, but we're not going to give you any score jumps because we know you're gaming the system. So if you've got flawless credit and never a blemish at all, well, that plan works. But if you've got one little tiny blemish, it's not going to help your scores at all.
Got you. And that's why I said I wanted to ask it, because I love the answer to that. And I know that's something that, has been out there for a while and I still hear it, but it's good to understand when it works.
Yes. Thank you, Devin. That was a great question.
Use a secured credit card.
Yeah, so there's no real difference on the credit score between secured and unsecured. It makes no difference at all. It used to be up until the year 2000, they changed that algorithm. And then you want to have at least 3 active, open, good revolving trade lines that are active, open, and current, greater than 12 months old. If you don't have at least 3 of them that are active, open, current, more than 12 months old, it's almost impossible to get in the high 700s. It is very hard. Okay. So for those of you folks that don't have at least 3 good revolving trade lines, you need to get 3 of them. And don't pick store cards, because what we're seeing now is a trend of some of these stores are closing. We've got a client in Malibu. There was a $4.5 million deal, and we almost lost it because one of her and her rate was at 6.5%. We're trying to get it to 2.25. I mean, that was, you can imagine that savings.
Yeah.
And we really had to talk underwriting into doing it, because we said, look, she doesn't have, some banks, they require you to have 3 when you do a home loan. It's not just the score, right? And well, she's got a good score. Look, she's never had any flaws. And they said, well, no, we're not going to do the loan because she only has 2 cards now. We're like, but her 3rd card just got closed because the store went out of business. So it's dangerous to be doing business store cards. All right, because if you're making up the 3, you should have Visa, MasterCard, maybe American Express, I call it. Because those I'd be pretty shocked if they went under. Okay.
And I love that advice, because I actually got bit with that too. I had enough revolving lines, it didn't matter, but I did. I had a card that I got like fresh out of high school, and they just BK'd, right? So like I got the notice that said like, you can't put anything on this card anymore. And it's like, well, not only could I not, it was a true store card, right? Like it wasn't a Visa store card that at least I could swipe somewhere else.
Right. Yeah. If you lose 20 years of history on a credit card, you're in trouble. By the way, on that note, if one revolving trade line gets closed, the older it is, the more points you lose. So let's say it's 20 years old and it gets closed, whether you close or they close it. I mean, I guarantee you're going to lose 50 to 100 points. Easy, gone instantly.
So that kind of goes to another bullet point on here. They have keep credit cards open. And I know there's a frequency, right, that you at least need to charge something on a card. What's that look like?
Yeah, the perfect world is, and you won't see this on the internet because who controls the data? It's the creditors.
The ones who want you to use it.
The ones who want to use it. You've heard that old urban myth, oh, but I was told, I heard from somewhere that I'm supposed to carry a balance on my cards. I'm like, who do you think started that propaganda? It's the credit card company, right? So here's the perfect world scenario. Remember, the closer we are to 0, the more points we get, but you got to use it off on a frequency, as Devin's mentioning. So here's the magic formula. $5 every 5 months. That's it. $5 every 5 months. Buy a cup of coffee on it every 5 months. You'll be okay. You'll be great, right? Now, why did I say $5? Well, a couple reasons. $5 is easy to pay off, right? And the second reason is we don't know when the bureaus are going to upload your data, whether it's the 1st, the 15th, the 30th. We don't know. So even if they upload a $5 bill, it's not really going to drop our score much, will it, Devin?
Gotcha.
Right. Okay. Now, the reason why I say every 5 months is because on the 6th month, if you've had a 0 balance on your card and you haven't been using it at all, on the 6th month, it starts to go idle, and then it will drop your scores. So what I suggest your viewers do is go to your Outlook or iCal or Google Calendar, and I'd like you to do a reoccurring alarm to alarm you every 5 months for the rest of your life. When that alarm goes off every 5 months, you go to the safe, you pull all the cards out at one time. That way it's easier to manage, keep on the same cycle. Like, was it JCPenney's I did, 5 months ago, or was it Macy's, right? Just do them all in the same frequency. Go put $5 on each card, put it back in the safe. When the statement comes out, pay it to 0. Here's another note. Wait until the statement comes, because if you pay it before the bill comes to you, it could go idle. Like Macy's is notorious for this. Capital One's notorious for this. I don't keep track of them anymore. But some of these creditors it'll go idle if you pay it before you get the statement, and it'll drop your score.
Perfect. That was going to be my next question is, do we need to wait for the statement, or can I just pay it off tomorrow?
Yeah. Wait for the statement. You can pay it that day.
So what I think is awesome about this, right? We won't show them, but here's my stack, because we met about 5 months ago and you gave me that advice. And I said, oh, that's great. I love that, because how do you remember it? Right. So I've got my stack on the desk, and today it's like the cup of coffee, the gas, the one trip to the grocery store. It'll all go on there, and all that's in my budget anyways. And then, I'll wait for my next statements. They all get paid off. And like, thanks, Don, for the advice.
Amen. You got it, brother. You got it.
I love it. So let's talk about, it looks like the last thing on here. Oh, there's 2. So let's talk about balance transfers, or like some creative loans to consolidate debt.
That's a good hot topic, trending topic right now, because people are, because of COVID, because of various reasons, the finances are tight. We get this question a lot. Hey, should we go out and do a consolidation loan, right? And consolidate some of this high interest rate debt into one loan? But that sounds great but it's never one box fits all. So I'm going to answer this very carefully because I care about you and your viewers. Is that remember, this is not one box fits all. Think of this first. What am I going to be doing over the next 12 months before you make a move with everything? Because what you learned earlier, about 10 minutes ago, is that I have to plan 1 year out of the curve. Because when I open up a new trade line, they take points away from for a year. Remember that? Right? So when you open up a new account, car loan, home loan, credit card, whatever, they take points away for a year. And on the 13th month, as long as you weren't late on that new trade line, they give your points back. So think ahead 1 year. So if you're saying, what do I do to consolidate this debt? And oh, by the way, I want to buy a house in 6 months. That's dangerous, right? If it's a year out, perfect. Then what I would suggest you do is you go to your credit union or go to a credit union, because they usually have the better consolidation loans. And generally speaking, depending on your income or assets that you have, they'll usually go up maybe 20, 30 grand, but that's pretty much about it for most of these credit unions. So, I mean, if you got 100 grand, and you're going to need to do like a line of credit against equity of your property, like maybe a U.S. bank loan line of credit. So if your debt's up there above 30, 50, 100 grand, you're going to need to get some real estate, and then do a line of credit. The U.S. Bank is one of the best, by the way. They have the most competitive rates, and maybe do a line of credit with them. It maybe usually around 6%. It fluctuates, but that's a heck of a lot better than 18 or 24%, right?
Love it.
Right. And then later, we enhance the scores even higher, and then do a refi, and then pay off that 6%. And now you maybe got like maybe like on a 30-year fixed, 2.25 or 3%, something like that.
Perfect.
Okay.
So last question on the credit topic. It talks about disputing errors on your report. So I don't want to get into the how-to and the whatnots, but I mean, what's the impact there? Is that something? I mean, I guess this goes back to you need to pull your report and look at it.
Yes. Yeah. The first thing I suggest you do, whether you think you have good scores or not, is see what the true lender's scores look like and get a copy of it, whether it's through one of your banker partners that does banking, or my firm, creditiq.org, and then look and see what needs to happen. Sometimes when we're coaching a client, we're just say, just do this and this, and then your scores will go up. You don't need to retain us to fix this little boo-boo here, because it's not really hurting your score that much, or maybe it is, right? And if it is, my background is aerospace, so I think like an engineer. And so I also got into mortgage banking and business coaching, for lending, is getting you ready for lending, things of that nature. And what I realized in life is there's patterns with everything. And so there's 38 questions that we can legally ask the bureaus, but we're only allowed to ask one question at a time. Most of these credit repair companies, they just take stuff and throw mud at the wall, right? And I hope it sticks, right? And then it usually comes back. You've heard those, right? So what our firm is doing is we're doing what's called forensics, all right, which is way different than credit repair. And so it's just knowing, like maybe Macy's, we would ask question number 10, where we wouldn't do that with Nordstrom's or a bankruptcy court, because we could deal with those too. So it's just knowing who the creditor is and what to ask them specifically. And that's how you really fix credit. When you're throwing mud against the wall, that's usually it's going to be a long process, and you may not be successful. I don't know if I'm answering your question.
No, I think that's great. And I think that's the little advisory notice, right? Is, a lot of the stuff we've talked about today, you could take action on, right? You can move. I think when we get into the disputing, that's where you need a good partner, and you need to be really careful who you partner with to get it done.
Yes, that's right. That's right.
I've heard some of those horror stories, and I'm sure another interview, maybe we'll just talk about horror stories.
Yeah, but there's a lot of those. I hear about those.
Awesome, man. Well, I appreciate the credit conversation. I always like to finish with 2 questions. So the first question is, if you look back at your career, what is something you would tell your younger self, a piece of business advice or something to a professional that would help them get ahead faster?
Good question. So I think I got my foundation from my father. He taught me, my parents, faith, family, friends, faith, family, friends. And then as I open my company, 31 years ago, and we expanded into 7 different firms. It took me a few years to, you and I were joking earlier about how, most people, they open up a business because they have this grand idea, but they're actually a little worker bee in the business, right? They're not, the business is managing them. They're not managing the business, right? And what I figured out after about 6 years is that there's a company in Marin, which wasn't too far from our corporate office, called Michael Gerber, eMyth. So what my suggestion to you is, folks, is that get your foundation in place, faith, family, friends, and you could also equate that to, relationships, right? Faith, right? Relationships with Devin and I, right? And your partners, systems, this is the, your CRMs, your coaches, Devin, once again, right? System and consistency, relationships, systems, and consistency, doing the same thing over and over and over. And I learned that from the eMyth. So if you haven't read it or listened to the video, eMyth, Michael Gerber, it's worth its weight in gold. I wish I had done that year 1.
Well, that's why we asked the question, right? Because I think we all have 1 or 2 of those lessons we learn in the journey where you're like, man, it would have been a lot less painful had I known this one thing, right? Yes. And everybody's one thing is different, right? It's interesting. Every time I ask this question, I've yet to have the same answer. Matter of fact, I've had people answer with books I've never even heard of, and I think I'm a decent reader. So that was my last question, and you already answered it. And we had actually talked about that before we started. So eMyth is your recommendation. I second that wholeheartedly. I think that especially if you are thinking about starting a business, maybe you have a great profession, maybe you're just grinding the 9 to 5 and you're like, look, I want to do something for me, for my family. You should read the eMyth, and you should talk to experts in the industry you're looking at going into and really understand what it's going to take for you to start a business. And because yes, you may be talented at one thing, but business requires all things. So That's you're right. Going to need to know, where are you going to supplement? When do you bring in really good partners, right? Your CPA, your insurance agent, your attorney, like these are things you're going to need, and make sure you budget and plan for that. So eMyth definitely gives you that mindset to think through business different.
100%. 100%.
Awesome, Don. Well, any last words? Below this video, we'll have links to everything from Don. Don, anything that they should be on the lookout for in those links? Any offers?
Yeah. So Devin's quite a good negotiator, and he says, "Hey, what can we do special for my readers and my listeners?" And I said, "Look, normally we charge $300, whether it's the business credit coaching or the personal credit coaching, because we do bankruptcy law, tax law, the credit restoration using forensics, cleaning up credit. And normally you charge $300 for a 3-hour coaching session in a Zoom meeting, and we're national. And that includes a copy of the lender's report on you and your significant others. If you have a significant other, it's just $50 for you guys combined, 3 hours, you get a copy of it. And so he's negotiated it down to only $50 for you and his team and the reader. So thank you, Devin. That was very generous of you. So it's $50. So when you click on the links below and you talk with one of our assistants when you're booking or scheduling an appointment, just make sure you mention Devin. Otherwise, it will be $3. So you need to make sure you mention Devin and his company. Okay.
Love that, Don. I appreciate that offer. And our goal here is we want to provide as much knowledge as we can. And we want to open doors to you guys so that you guys can move your business forward, right? I loved when you talked about, like, are you leasing a building and should you own it? Like, I want to have that conversation with you. I have a couple commercial realtors coming on, and maybe we do a little roundtable, because it's such a good strategic move to build some equity. So
have other renters pay your mortgage, and then you get equity going at the same time.
Weird. It helps your balance sheet too, huh?
Yeah, exactly.
Well, Don, I appreciate your time. So much good knowledge in here. I'm sure we'll do a part 2, and we'll plug you into some future interviews. As always, thank you for your time, and we'll chat with you soon.
All right, Devin. God bless you. Take care. Have a good day.